Good evening, everyone. It's my pleasure to be here tonight, and it's fantastic to have the chance to talk to a wide audience about the questions that we're asking in areas of organizational psychology and human resource management. So I want to talk to you tonight about a debate that's ongoing in the field right now regarding the use of financial incentives to promote work motivation in the workplace. Is this working? Hold on. I think I'm going to use this instead. Yeah, oh, that's fine. Thank you. So to briefly define to you compensation, it's basically very simply defined. It does involve other things, but I'm keeping it very simple tonight. I focus here on the money that people receive in exchange for work that they do or for services that they provide. And when we talk about incentives, this money is more closely linked, more contingent on the performance that people enact on their job. So when we talk about incentives here, can speak about bonuses that are for reaching a performance target, commissions on sale, piece rate systems where you get a small amount of money for each piece of, let's say, widgets that you make, profit sharing, which is basically that the organization shares the profit that it's making with its employees, and merit increases in base pay that are based on your, for example, annual performance. So I'm sure that all of you are familiar or have received these kinds of incentives at work, and so this is the focus on the research on incentive systems that is currently being examined in the field. Compensation is a major policy lever that organizations use to try to motivate employees. So they try to attract people in organizations through giving them competitive salary packages. They try to motivate performance by offering incentive pay. And they also want to try to retain people in organizations by offering them competitive pay. And if you look at economic studies, looking at it from the perspective of the organization level, you do see increases in organizational performance in the range of 4 to 9% when organizations provide incentive pay to employees. But this effect is quite limited. So, for example, incentives have an effect on performance quantity, but not so much on performance quality. In manufacturing settings, incentive systems have been shown to have the same effect as goal setting, which is setting goals for employees that they try to reach and providing them with positive feedback when they perform well. So you wonder why we would spend all of that money and having to measure performance and doing all these things if you don't get anything more out of incentive systems than you would by setting good goals for employees and by giving them good feedback on their performance. In addition, in service settings, so in organizations that provide services and not products, financial incentives have actually been shown to worsen the performance of employees, so worsen the type of service that they provide to beneficiaries or clients. And it's also been shown through both studies, lab studies, field studies, and meta-analytic findings that incentives only work for very simple tasks and boring tasks. When tasks are genuinely interesting, complex, so they require, for example, complex problem solving, lots of creativity, you can actually worsen that type of performance through the use of incentives. These studies that have been shown to work for simple, boring tasks, I'll give you some examples of studies that have been included in that. Fruit picking, rat catching. And so these are the kinds of things that have been studied in relation to piece rate systems. So you wonder, with the type of work that we do today, which is much more knowledge-based, much more complex, how appropriate it actually is to use financial incentives. And the thing is, incentives also have other side effects. So they've been shown to decrease people's enjoyment of their work and to decrease work effort. They, in some studies, have also been shown that if you pay people a lot based on incentives, so that their compensation package is heavily based on incentives, they tend to leave the organization more quickly. So turnover rates are much higher in these kinds of, with these kinds of incentives. And one of the arguments is that it's because people find it very stressful to work under a system like that in order to make sufficient money to live. And so, for example, in one recent study that I was involved in Norway with some Norwegian colleagues, they were looking at insurance salespeople. And we did a before-after design where in the middle we introduced a bonus system. And turnover rates increased following the introduction of that bonus system for these insurance salespeople. So these are things to consider. Other things that have been shown to happen following the introduction of incentive systems is that people sometimes engage in excessive risk-taking. It increases competition between people within an organization. It gets people to focus too little on performance aspects that are not rewarded by incentive systems, but to focus too much on what is getting rewarded. So people focus narrowly on what gets rewarded and nothing else. So a recent review of all this work has concluded that, when incentive systems work, they work great. You get great performance, but when they fail beautifully as well. You get very bad results. And so what should we do? So what we know works is it's important to pay people well. So how do you define well here? It's by paying people in a way that will make them feel valued by the organization. You can define that as paying at least at market share, like at market level or slightly above market level, for example. But that's something that has to be worked out with the employer and employee group. Something else that has been shown to work very well is, of course, paying people fairly. So when people always compare themselves to others, that's something that's very basic to human beings. So if they feel that they're compensated fairly in terms of the effort and the skills that they bring to the organization relative to someone else who might bring something similar, then that will enhance their motivation to work. Not having too high a ratio of variable versus fixed pay. So the variable part is those incentives on performance, and the base is the base pay that you get for being in the organization and doing the work that you're supposed to do. So when the ratio is really high on the incentive side, it tends to increase feelings of, like stress reactions and things like that. Also, having fair procedures to assess performance on which the incentives are based. If people feel that their performance is not assessed accurately or objectively, that will influence how they will feel about the incentives that they're getting. And be careful not to create competition through the incentive systems. So it's important to try to increase cooperation so that people work together to accomplish the organizational goals and not against each other to try to get something for themselves. So that's also important to do. However, it has been shown that group incentives sometimes can increase peer pressure within the group. And again, that can create some problems. So there's always a caveat behind the incentive system. What also works, and this is what like all of my research on work motivation has shown, is that you might not need to use pay as the sole motivator of performance. There are many other things that motivate people to do their work. And so I will talk to you very briefly about what I call the ABC of motivation. If you want people to be motivated, and what I mean by motivated here is true engagement. It means that people find that what they're doing is meaningful and or they enjoy the work that they do, so they have high intrinsic motivation. So you want to make sure that people have autonomy in their work, that they can make some decisions or participate in decision making and feel that they are responsible for the work that they do. The second thing is you want to make sure people feel that they belong. Humans, we are social animals, right? So people need to feel connected to other people. And when they do, they thrive, and their motivation, they can focus on their work. They don't have to focus on trying to fit in or anything like that. And the cooperation that's created through that also enhances performance. And finally, you need to make sure people feel competent in what they do. So select the right people, train them appropriately, offer them the resources that they need, and offer them continuous support and feedback on their performance, because that informs them about how competent they are. So by doing these things, you get that more meaning and enjoyment-based type of motivation. And then you don't have to focus on dangling a carrot in front of them to get them to do what you want them to do. They will do it because they think it's important, and because they are passionate about what they do. So that's my ending message. Thank you.